Figures out today show an unexpected fall last month from 2.9% to 2.6%. The CPI rate had been expected to either rise or stay at its previous level. The Treasury responded saying, while it is encouraging that inflation was lower this month, we appreciate that some families are concerned about the cost of living. Let's go live to the City and our business presenter, Ian King. So, Ian, painting the picture of what's going on in the economy, what do these figures tell us?
Well, I think these figures will be broadly welcomed, Adam, because most people had expected inflation to remain at the level it was last month of 2.9%, which was a four-year high, of course. So 2.6%, significantly less than expected. There'd even been speculation that you might see inflation, CPI inflation, going to 3%, which would have been the point where the Governor of the Bank of England, Mark Carney, would have had to have written a letter to the Chancellor explaining why inflation was 1 percentage point higher than the bank's target rate of 2%. Now, the main factor behind this appears to be the drop in oil prices. Crude oil prices have come off by something like 15% during the last 3 months, and that's largely because the OPEC production cartel has found it very, very difficult to enforce the production cuts that it brought in November last year. And of course, you've got the US shale gas industry pumping out gas for all it's worth. That's depressing global fuel prices as well. And that appears to have fed through to lower inflation prices. But the other factor, which I think people will take encouragement from, Adam, is the fact that obviously after Brexit, the Brexit vote, we had this big drop in the pound, and that fed through to the kind of higher levels of inflation that we've been seeing in recent months. But there are implications in these latest figures that imported inflation from the weaker pound is actually starting to tail off. And one little clue to that is in the recreation and leisure category of the inflation figures out today, which a lot of which is imported costs, and that has come down quite substantially. So pretty good news on the whole. We're not out of the woods yet, but I think it certainly lightens the pressure. There's been an awful lot of speculation, as you know, that the Bank of England Monetary Policy Committee might be inclined to raise interest rates, raise the cost of borrowing in August as a result of these higher inflation figures that we've seen in recent months. Certainly the last MPC vote, you had the tightest vote. You had more people voting for a rate rise than for some considerable amount of time. I think the pressure is off, and accordingly, you've seen sterling falling on the foreign exchanges this morning. It's off by about 0.75% against the dollar and slightly less against the euro. Now, one point to make, Adam, though, is that while we're talking here about consumer price inflation, we also have retail price inflation, RPI, the old measure, of course. Now, that came down from 3.7% to 3.5%, but that is obviously pretty high by historic levels of recent years, and that's an issue for the government because that is the rate that is tied into things like student loans, the interest rate charged on student loans and on the interest rate on index-linked government debt. So the higher that is, the higher the government's borrowing costs are. So it's not unalloyed good news, but I think most people will be quite pleased at these figures today.
Ian, thanks very much indeed.
You didn't frankly have the balls to put country before party.